Let's start. Imagine a stock market where absolutely no human beings exist. There are no frantic traders shouting on the floor, no analysts reading financial reports, and no investors looking at long-term growth. It is just thousands of glowing black servers locked in heavily air-conditioned data centers, silently screaming at each other in binary code, executing millions of trades in the time it takes you to blink your eyes. This isn't a science fiction concept for the distant future. This is the exact reality of the global economy right now. We are currently terrified that artificial intelligence is going to take over our jobs, our art, and our internet. But what most people don't realize is that autonomous algorithms already conquered the heart of global finance over a decade ago. And on one seemingly normal afternoon, they proved exactly how fragile a machine-controlled world really is. They proved that when you remove humans from the economy, you don't achieve perfect mathematical efficiency. You build a doomsday machine. To understand how artificial intelligence and autonomous algorithms broke the economy, we have to look back to the birth of high-frequency trading. By the late 2000s, Wall Street had completely changed. The era of the human stockbroker yelling into a telephone was dead. The new kings of Wall Street were the quants, brilliant mathematicians and physicists who built incredibly complex, hyper-fast algorithms. These algorithms, known as high-frequency trading bots, or HFTs, didn't care about a company's fundamentals. They didn't care if Apple made good phones or if Ford made reliable cars. They only cared about micro-patterns in the data. They were designed to detect when someone was about to buy a stock, jump in front of them, buy it first, and sell it to them a fraction of a penny higher. They executed trades in microseconds, millionths of a second. By 2010, these algorithms controlled the vast majority of all trades in the United States stock market. Humans had completely surrendered the steering wheel to the machines. The financial elites argued that this was a good thing. They claimed the algorithms made the market more liquid and more efficient, completely removing human emotion and panic from the equation. But there was a massive, fatal flaw in their logic. These algorithms were incredibly fast. They were capable of processing oceans of data at the speed of light. But they were also incredibly stupid. They had no common sense, no context for the real world, and absolutely no understanding of what the numbers actually meant. And one man sitting in his bedroom in London figured out exactly how to exploit that stupidity. His name was Navinder Singh Sarao. Sarao wasn't a billionaire hedge fund manager. He wasn't a Wall Street executive in a custom suit. He was a 31-year-old day trader who lived with his parents in an incredibly modest house in the suburbs of West London. He traded on his computer from his childhood bedroom, surrounded by stuffed animals and sports posters. But Sarao possessed a brilliant, almost savant-like understanding of how the market actually worked. He spent his days watching the order book, the digital list of all the buy and sell orders in the stock market, and he quickly realized that the massive, multi-billion-dollar, high-frequency trading algorithms had a major vulnerability. Because the algorithms were programmed to react instantly to market pressure, they were incredibly predictable. If an algorithm saw a massive pile of sell orders suddenly appear on the screen, it would panic. It would assume the market was about to crash, and it would immediately start selling its own stock to avoid taking a loss. Sarao realized he didn't need to be faster than the algorithms. He just needed to lie to them. So, Sarao built his own bot. He programmed it to execute a highly illegal strategy known as spoofing. The strategy was brutally simple. Sarao's bot would place massive, multi-million-dollar orders to sell stock at a specific price. These orders were totally fake. Sarao had absolutely no intention of actually selling. The Wall Street HFT algorithms would see this massive wall of fake sell orders appear in the data. The algorithms, lacking any human common sense, would instantly panic and begin selling their real stock, driving the actual price of the market down. In the exact microsecond before Sarao's fake orders could actually be executed, his bot would instantly cancel them. The fake sell orders would vanish into thin air, but the damage was already done. The HFT bots had already driven the price down. Sarao would then casually buy the cheaper stock, wait for the algorithms to calm down and the price splice to recover, and sell it for a massive profit. He did this over and over and over again from his childhood bedroom, quietly siphoning tens of millions of dollars directly out of the pockets of the most powerful financial institutions on Earth. He was essentially playing a massive video game, using a cheat code to trick the smartest computers in the world. But on May 6th, 2010, the cheat code broke the game. The morning of May 6th was already incredibly tense. The global markets were highly stressed due to a massive debt crisis brewing in Greece. Human traders were nervous, and the algorithms were highly sensitive to any sign of a crash. At 2:42 p.m. Eastern Time, Navinder Sarao turned on his spoofing algorithm. His bot began placing massive, aggressive fake sell orders on a financial product called the E-mini S&P 500, essentially a massive bet on the entire US stock market. Instantly, the Wall Street HFT algorithms saw the massive sell wall. Because the market was already fragile, the algorithms reacted with maximum panic. They began aggressively selling off of their real assets to escape the perceived crash. But this time, it didn't stop. As the algorithms began to sell, other algorithms algorithms saw that selling and reacted by selling even more. The machines entered a catastrophic, irreversible feedback loop. They were trading with each other, reacting to each other's panic at the speed of light, completely disconnected from any human oversight. Within minutes, the stock market went into absolute freefall. The Dow Jones Industrial Average, the bedrock of the American economy, plunged nearly 1,000 points. It was the largest intraday point drop in the entire history of the stock market. Over $1 trillion of wealth literally evaporated into thin air in less than 10 minutes. The machines were moving so fast and the data was so corrupted by the feedback loop that the pricing mechanisms completely broke down. Shares of massive, highly profitable, blue-chip corporations suddenly dropped to a price of exactly one single penny. Conversely, shares of completely worthless companies, cum dollars, momentarily skyrocketed to over $100,000 a share. On the floor of the New York Stock Exchange, human traders stood frozen in absolute terror, staring at the glowing red screens. They couldn't do anything. The machines were moving millions of times faster than human reflexes. The economy was completely out of control, tearing itself apart in a dark pool of synthetic data. It was the first major algorithmic crisis in human history. It became known as the flash crash, and then, almost as quickly as it started, it ended. Human regulators and exchange officials, realizing the system was literally disintegrating, essentially pulled the plug. They paused trading on certain key assets. The algorithms were forced to stop and reset. By 3:07 p.m., the market had miraculously recovered almost all of the losses. The $1 trillion returned to the ledgers. The entire catastrophic event, the collapse and the recovery, took exactly 36 minutes. Navinder Singh Sarao was eventually caught. Years later, the FBI extradited him from the UK to the United States, where he was charged with wire fraud and market manipulation. The media loved the story of the lone genius, Hound of Hounslow, who outsmarted Wall Street from his bedroom. But the story of the flash crash isn't really a story about a brilliant day trader. It's a massive flashing red warning sign about the fundamental architecture of the modern world. Fast forward back to today. We are currently entering the era of the dead internet. We are rapidly building an ecosystem where artificial intelligence agents are no longer just answering our questions. They are actively operating in the economy. Imagine today, AI algorithms aren't just trading stocks. They are deciding the price of your airplane tickets. They are automatically adjusting the rent on your apartment using massive algorithmic databases like RealPage. They are dynamically pricing the food you buy at the grocery store. We are building a synthetic economy. An economy where an AI agent acting on behalf of a corporation negotiates a price with an AI agent acting on behalf of a consumer. The promise is exact same promise the quants made in 2010. Perfect mathematical efficiency. If we remove the slow, emotional humans from the equation, everything will be perfectly optimized. But the flash crash proved that when machines trade with machines, they don't create stability. They create an incredibly fragile glass floor. When a human landlord sees that nobody is renting an apartment, they lower the price because they need the cash to pay their mortgage. They possess human context. But when an algorithmic pricing software sees a market anomaly, it doesn't possess context. It only follows the math. What happens when an AI software managing the global supply chain of wheat gets into a mathematical feedback loop with an AI software managing the pricing at major grocery stores? Because these systems are totally interconnected and because they operate at speeds incomprehensible to human regulators, we could easily see an economic flash crash, a scenario where the price of a loaf of bread skyrockets to $1,000 for 5 minutes because two algorithms got stuck in a logical loop. We look at the stock market as a reflection of the real world. We look at the price of goods as a reflection of human supply and human demand. But we are rapidly approaching a moment where the numbers on the screen no longer represent the physical reality of the human beings living underneath them. The 2010 flash crash was a warning. It proved that when you build an economy entirely out of algorithms, you are no longer a participant in that economy. You are just the organic matter living inside the machine. If you want to understand how these invisible financial systems were built and how they continue to control your everyday life, hit subscribe. We explore the hidden history of money, the mechanics of power, and the economic forces that shape our reality. We spent thousands of years building economies based on human trust, human labor, and human consequences. But in our endless pursuit of efficiency, we handed the keys to the kingdom over to the machines. The algorithms don't know you. They don't care about you. They only care about the data. The next time you see a price inexplicably surge on a website, or watch the stock market plummet for absolutely no reason, remember the 36 minutes where the machines nearly deleted $1 trillion. The crash wasn't a glitch. It was the system working exactly as it was programmed to. And the scary part is, we are plugging more of our lives into that system every single day.